G'day, expats, and welcome to another episode of Expat Chat, episode 181 today. And as always, joined by my mate and colleague, the Managing Director for the APAC region. G'day, James Ridley.
Good morning, Brett Evans, and thanks for having me on for another episode. I really appreciate it. For those
Mind you back.
tuning in, for those that are new to the show, actually, and you're listening to Brett Evans, who's the founding director of the Atlas Wealth Group, currently the managing director of Atlas Wealth Management over in Europe, Middle East, and Africa's region. Good morning, mate. How are you? You must be gearing up for a bit of leave coming up soon.
I'd be lying if I didn't say I was counting days right now. It's been a hell of a year for good and bad reasons, but generally speaking, good. And
Yep.
yeah, the bandwidth is a bit narrow and end of
Mm.
financial year coming after a war. Just a very busy year for Atlas as well. So yeah, I'm
Yeah, has been.
pretty fatigued, as I say. So, but mate,
Yep.
let's have a chat about what we're going to discuss with the good folks today. And it's a bit of
Yep.
a bit of a mixed bag. Do you want to run through what we're talking about?
Yeah, it is. I mean, today, just some general topics to cover off on that recent CPI print that we saw for the month of May. It's hard to believe, but there's been some more changes to the budget and the proposed changes in legislation around SMSFs. And then we've got some loaded Q&A from a lot of listeners that have sent them in. So we thought we'd run through a couple of questions and unpack them a little bit. But before we do so, let's get the compliance
As we
mumbo
say here in
jumbo
the Middle
out of the
East,
way.
let's do the needful. All the information we're going to share with the amazing listeners today should be treated as informational, educational purposes only. Please do not construe this as personal advice. If you do need to get personal advice, then please speak to a specialist who's licensed and experienced like Atlas.
Yep, that's exactly right. And I mean, first cab off the rank, talk about inflation. So
Yep.
the month of May came out and it still crept up. It's obviously trading at about that 3.6, 3.8% at the moment, the trimmed mean. I honestly thought headline inflation has a 4 in front of it, but I think I've said previously, I thought we'd be starting to see sort of that 5, 6% from the flow-on effect of the Middle East. So I've actually am quite shocked that we're not as high as what I predicted, to be honest. We're actually a lot lower. Um, again, based on what we're seeing, headline CPI for month of May was, sorry, 4%, down from 4.2% from April, but the trim rim rose to 3.6% on the 12 months. And then the weighted median was about 3.6 monthly. So CPI actually fell down a little bit there. But I'd say that we've just got to bear in mind that this is just the monthly readout. When we get the quarterly readout from June,
That's the juicy one.
God, oh, it is. The data that's in there is terrific, and unpacking it will be really exciting. That gets released at the end of July, 29th of July, and then we do have the RBA meeting around August 11th. So if that's quite juicy, that inflation print, then we might be staring at a rate increase.
And I'm surprised because the Australian dollar's fallen back on the expectation there would be no more rises. But to be honest with you, I'm watching the unemployment rate closely. I think that's the canary in the coal mine. And
Yep.
it hasn't gone up. Actually came back. We created more jobs and lost jobs in this week's number. So that tells me there's capacity still in the economy. There's capacity
Yep.
for the RBA to give it a bit of a nudge. Like we spoke about in the last episode, the biggest fear that central bankers have is embedded inflation. So
Mm.
watch this space. That could be a very interesting one as well too. So then I think we're all surprised by the headline inflation number. I think I saw forecasts of 4.8s and stuff, but didn't
Yeah.
quite get
Yeah,
there.
that's right.
But
Yep.
it's the trim mean one, which is what the RBA focuses on, that more long-term stripping out seasonality and that sort of
Yeah.
underlying inflation that they're focusing on. And that surprised people by going up. So it's funny how everyone was expecting a higher headline, lower trimmed. In actual fact, it was the other way around.
The
So
opposite. Yeah, I know.
yeah, I think, with that unemployment number and that trim mean number, obviously once we get those June numbers in July, um, if that is at or above, then I think game on for August.
Yeah, yeah, that's exactly right. I think I was looking at the ASX rate tracker, and it's still showing a bit of a hold at the moment based on what everyone's predicting. But if that inflation data for June is nasty, very well could see another 0.25 put on the board.
Yeah. And
Yeah,
folks out there,
absolutely.
as we've always said, if you are of the same boat as James and I, and we're in the same boat, I should say, and you think there'll be a rate rise and you are moving dollars back to Australia, guess what? the AED's got a 6 in front of it to the US. So if you are going to
Yeah,
do it, if you've been
good
sitting
time.
at 72 saying I'm not going to do it, now may be your time. So have a look at
Yeah,
that.
absolutely. Trading a 6.8 at the moment. So get some while you can before it all changes once more. Because if the market predicts and expects that we'll see a rate increase, US AUD could be trading above 70 cents again, 71, 72 cents. That's
Yep.
how quickly it can move. Now, another update to the budget. I feel like every week there's a new
It's the gift that
legislative
keeps on giving,
update.
isn't it?
It's hard to track at the moment, to be honest. I've got whiplash. But yes, somehow they've managed to sneak in a change to superannuation. Labor's done a deal with the Greens, and it is around self-managed super funds. So they want a restriction placed on SMSFs to being able to invest in residential properties. So essentially, going forward, after it receives royal assent in the coming weeks, probably around mid-August, if you have a self-managed super fund, you will no longer be able to invest in any sort of residential property through your SMSF. Current properties that are already owned in SMSFs, that's fine, they'll be grandfathered, but you won't be able to buy another one. They're sort of saying no more, just to maybe bring out a bit of heat in the residential property market. I don't think it really moves the needle, to be honest, because right now residential loans, investment loans, make up less than 1% of the home loan market. So
Yeah.
shit, I think
And
it's just a, yeah.
just for clarity there too, it's SMSFs can still buy properties that it can't use gearing using
Yep.
LRBA
Yep. That's right.
functionality. So
LRBA. That's
yeah,
right.
so if you have an SMSF, which if you are an expat, you shouldn't. But if
No, yeah,
you're
hard.
back in Australia or just return back to Australia, you can still do it, but you just can't use gearing as part of that functionality,
That's
which makes the
so
premise of
that's right.
buying residential property in SMSFs even worse because
That's,
not, look at the average median house price in Australia, is about, it's got $1 million. If you've
yep.
got $1 million in super, that's a juicy amount. Would you put that
Hmm.
all in one asset class, in one
No.
location, in one geography? No. And especially at the
Yep.
yields that property in Australia kicks off, no,
Yeah.
doesn't
Yep.
make sense at
No,
all.
not at all. Not at all. So yeah, that's right. You'd be cash buyers in SMSS for residential property, whereas your commercial, industrial, those sort of things, off, buying a shed or a warehouse that's rented to a plumber or something like that, that is still on the cards.
Yep.
You'll see more lenders now leaving sort of that SMSF market, which means I could also probably see interest rates in that market increasing as well because there's not going to be many left to the party.
Yep.
Um, so just another change. That'll go all the way through now. That should be legislated. We should see it's all drafted and royal assent very soon. Now, the last piece of the big changes that were announced as part of the budget is the trust legislation. So we have
Yep.
not seen the draft legislation on that just yet. We are waiting in the wind for that one. It'll probably be released, I'd say, in the next month or two, because they often do it in two tranches, which is rather important.
100%. And that's the thing. I think they realised they bit off more than they could chew by trying to push this all through. And then now they've seen obviously the change of the testamentary trust and those things. It's like, well, their pet project, their favourite child is negative gearing and capital gains tax. So let's focus on that. Let's
Yep.
do some devil deals with the Greens to do what we have to do to get it through. And then
Hmm.
we'll tick that one off next after we've got the first one through.
Yeah, I mean, we'll see if see if Labor holds the seats when we come into the next federal election. One Nation, the way they're tracking at the moment,
I know.
they could be the leaders. So we'll have to wait and see. Coalition could be old news. But yes, some big changes afoot, especially back in Australia. Hopefully by the end of the year, all those updated legislation is all laid out cleanly. We know when they start, the start date, when they're effective, and then off the back of that, we can start doing some tax planning with clients. So
100%.
I'm looking forward to all that being closed off. Switching gears into a bit of Q&A from our Australian Expat Financial Forum on the Facebook. Couple of good questions here. Let's jump into them. A good question here. I'm just going to read it out as it reads. This one's from Florian. If one moves overseas permanently and at least a 10 to 15 year time horizon before retirement slash super release, how does keeping super in an industry fund compare with keeping a wrap account, especially in terms of cost or ease of maintenance or the relevance of an ongoing advisor slash relationship? Good
That's a
question.
good question. Yeah, look, we get that question a lot. And the very simple one to foreign and anyone else out there who's sort of going through this mental gymnastics of whether to do it or not is, have you tried to set up a new bank account or change your details with your Australian bank?
Mm.
Sitting on hold for hours on end at a foreign time zone, it doesn't work. It doesn't work.
Yeah.
The reason why the fees are so low is because you don't get a lot of functionality. You don't get a lot of service.
No,
You're talking to a
no.
call center. No one knows who you are. And what that call center can't do legally and experience-wise is tell you how that account interrelates to where you're moving to. That's the big one.
Mm.
So
Yep.
a lot of people don't realize you're moving to the US. US doesn't classify Australian super accounts as foreign pensions. They could be classified as foreign trusts, employee benefits trust, foreign graduate trust, depending. There's a lot of reasons. Even just to me, the functionality of being able to pick up the phone to your advisor to say, hey, I want to do this with my account. I want to change my investment model and this sort of stuff, or I want to do this, or just even understand the changes of super legislation and how that affects you.
Mm.
Call center can't do that. So
No.
don't always be too hamstrung on fees and charges. I've seen clients lose money by chasing low fees. Low
Yep.
fees doesn't always mean high returns and vice versa.
Yep.
Nor should you buy something based on promised returns. But it needs to be find a balancing act in terms of what support do you need. We'll get some clients who should have been financial planners themselves.
Mm.
They know heaps. And I sometimes wonder, why are you using us when you know as much as I do?
Yep.
Those sort of people, they can manage the stuff themselves. But that is the
Mm.
minority. Most people don't really have an idea. And if you are looking at 10 to 15 years, consider this. If you are invested incorrectly or have the wrong account or it's set up incorrectly, if you're not getting a 7% return net of fees every year for 10 years, you're not going to double your money. Whereas if you had everything
No.
set up right and net of fees, you're getting 7%, you double your money with very
Yep.
heavy lifting. So it's more than just that. I mean, to me, some funds, ING is one of them. Guess what? You tell them you're moving to France, Hong Kong, US, Dubai, they'll kick you out in 28 days. Do you have life and
Trust
TPD
me.
insurance inside of that account? Is that valid? We've had hundreds of cases of people paying premiums on insurance that they
Mm.
can't even claim on. So it's not just a matter of compare the pair, which is a bit of a furphy. I mean, it's comparing a 1980s, Volkswagen Beetle to a modern day, Mercedes-Benz, in terms of,
Mm.
yes, the Beetle's cheaper than Mercedes-Benz,
Mm.
100%. But
Yep.
do you need a Beetle or do you need a Mercedes-Benz? So you can't really say compare the pair because there's a lot more to that. I think the other last
Yep.
thing I'll touch on is, and a lot of people that don't know this, inside
Mm.
super, 15% tax on income.
Yep.
Now, if you are an industry fund, the tax credits don't flow through to you. It gets amortized
No.
across the membership. So whether someone's in 100% cash or 100% high growth, they all share the tax
Mm.
credits. Think of it like the communist way of investing. It's sort of like the state handles everything.
Yep.
Whereas if you are in a retail wrap super fund, which is what you're talking about, guess what? Franking credits flow directly through to you. So what that
Yeah.
means is if BHP is going to pay a dividend of $100 to someone in Australian super versus someone in, say, Hub24 net wealth premium, that Australian super person will get $85 because 15% will be withheld.
Mm.
In a retail wrap, guess what? They'll still have that offset. So franking credits are 30%, income is 15%, so that's a net. But because it's a closed and preserved environment, guess what? The ATO actually refunds you at the end of next year the 15% unused franking credits. So while everyone's getting 85, you're essentially getting $115 equivalent.
Yep.
Now, run the numbers, it pays for any and all fee difference, any and all fee
Yeah.
difference. And we're not even getting into the ability to in-specie transfer holdings at retirement instead
Yeah.
of crystallizing gains. And
That's right.
look, you and I
Yeah.
can go down a hole. So to me, you're not comparing the pair.
No.
But
No.
it's
Not
more
at all.
from the functionality point of view. If you're moving to a country, do you have someone in your corner that you can pick up the phone to that helps you make decisions on your super?
Yeah, I absolutely. There's not really anything I can add to that except for with a lot of industry funds, especially when your balance gets up to a significant level, the percentage-based fees that you pay on the investments is actually quite high. And when you're in a wrap-like platform, the cost first product can actually be much more cost efficient being on the wrap platform. Obviously, without going into the benefits, advantages that Brett just mentioned with Florian, just bear in mind, you've just told us that you've got a 10 to 15 year time frame until you retire. This means you're probably entering, if not you've already entered, your peak earning years. These are the years which really matter when it comes to building your retirement. And if you're not focusing on building up super, given that you've said that you're coming back, then you really need to start thinking through that and what are you leaving and what are you building for yourself back in Australia, and how does superannuation form part of that as well? So good question, really good question. We unpacked that really well. Changing on to the next question, tax residency. Oh, sorry, I haven't saved the name here. This might be Jen. Tax residency. What if the country you reside in is not the country you get your income from? Example, living in the United Kingdom, but your income, investments or salary or pension is from Australia.
Just comes back to where you're tax resident of. If you
Yeah,
are
yeah.
tax resident of the UK, whether you're getting income from Australia, United States, Antarctica, doesn't matter. You all have to declare that as part of your HMRC tax return.
Mm.
Where it gets a little bit interesting is if there's any tax paid in that country of earning, whether
Yep,
there's a DTA between UK and that country, if that
yep,
foreign country has debited any tax on your
yep.
behalf. So yeah, I'll hand
Yeah,
that over to you.
that, that's exactly right. Yeah. So wherever you're a tax residency, they're going to have their own sort of, uh, depending on the DTA, how they sort of tax things like Australian super or pensions and those sort of things. Um, with Australia and superannuation pension, because they have mentioned it specifically, that's agnostic regardless of your tax residency. So if you're a non-resident of Australia, but you're drawing a pension out of your Australian super, that should still be tax-free here in Australia. If you're in the US, it's definitely taxable. If you're in the UK, yep, you do pay that
Taxable.
tax on that.
France,
Um,
Spain.
it yeah, a lot of those countries, you still declare it as an income stream. And because the amount is tax-free, there's not usually a tax credit that you can use, unfortunately, in that country. I know New Zealand's actually tax-free
Yep.
if you're residing there. How it's treated in Australia is how it's treated in New Zealand. We often get a question around, do I move my superannuation monies into KiwiSaver? KiwiSaver, you actually pay tax on the dividend and income depending on your marginal tax rate in New Zealand. So often we actually found out that it's much more tax efficient. Keep it actually in your super fund account and still
Yep.
keep contributing to your Australian super, and then withdraw it as a pension, and it's still tax free. It's actually really interesting. The system allows for it. There's a bit of tax arbitrage that you're making there. Um, but yeah, depending on where you're residing, that's going to obviously dictate how you're going to pay tax on that kind of income, salary, wages, pension, all those sort of things. That's a bit of a broad question. Yep.
Yep. But yeah, essentially you'll pay tax in the country that you live in as a tax resident is the best way to
That's right.
summarize it.
Yep. Yeah, exactly. Another question here from Chithan. It's regarding self-managed super funds. So we
Yep.
talked about this, a lot of previous episodes to cover off on this one, but hi everyone, I need to get some help here on maintaining compliance of my self-managed super fund while living in Dubai as an expat. Can someone guide me in the right direction?
Great question. And we see this a lot, and especially more so in the last 5 years with the
Mm,
increasing popularity of SMSFs.
SMSFs. Yeah,
So,
yeah.
do you want to run through, James, what they have to do to make that SMF compliant, or what happens if it is not compliant?
Yeah, I mean, it is hard to maintain a complying self-managed super fund when you're living overseas. Still comes back to the three tests. So the first one needs to be established in Australia. That's like obviously the first principle.
It's given.
You've then got you've then got the membership base, and then you've got the active members test as well. Um, if we consider the structure of a self-managed super fund, so usually when you set up an SMSF, you install what's called a corporate trustee on the SMSF. So that's a company. Usually, if it's just you as the member and that's it, you'll be the director of that corporate trustee, and then it'll be your superannuation monies in there invested in different assets, shares, crypto, property. Usually you only set up an SMSF if you want to invest in physical property, because the other ones you can get access to a lot of other platforms these days, and crypto as well through ETFs these days. If you move overseas, because you're the director of that corporate trustee and you're the only member and you're a non-resident, if the ATO catches you, you'll be deemed to be running a non-complying SMSF. And the main reason for that is central management and control needs to be maintained in Australia at all times. However, if you're living in Dubai forever, permanently, central management and control is not being maintained in Australia. Now, there is something called the temporary absence rule, but you can only use that in essentially the first 2 years of moving overseas. And that's really it. You can't keep coming back every couple of years and say, yep, I'm running it. And even though I'm just back here in Australia, because then they look at your residency and then they also link that to the active members test. If you are a non-resident, you cannot breach the active members test. And an active member is someone that's contributing funds to an SMSF. They are rolling in funds from an SMSF, from a retail super fund, industry super fund. If you do that, your SMSF will be deemed to be non-complying because you're a non-resident. The workarounds, there's not too many good workarounds in this instance. If you're just the sole member, then we do see and come across people installing an enduring power of attorney and doing what's called rubber stamping. You know, they're applying and getting a mate on there as another director of a corporate trustee that's an Australian resident, but they've got no assets in the SMSF. The issue with that is if the ATO ever finds out that's how you're running it, they are comfortably going to say, you're not running this SMSF. The vested interest of that other director who's a resident, none whatsoever within the SMSF. And therefore, they are just going to lean on the fact that you're still running it. You've just done so as a form of rubber stamping. The other option is small APRA fund. You can convert it into a small APRA fund. There's a few trustee services back in Australia which will do that, and usually they'll charge you a fee annually for it. And that's probably the most compliant way to keep the SMSF ticking over, installing it or a trustee as a small APRA fund. If you've got other members of the SMSF and your balance is smaller than 50%, then you can still maintain it as long as those other members are Australian residents, but you cannot breach the active members test. So you can't contribute to it. You can't do anything with it. Your balance that's in there as part of the assets just stays there. That's it. If you want to contribute to super, you can only do so to, say, an industry super fund.
Yeah, and I think the other thing too about small APRA funds is they sound great. They sound like the answer, except
horrible.
They will put on you quite punitive requirements in terms of, because the risk is on them. So if if your SMSF is just 100% crypto or 100% one property, one of the things that the provider's got to do is say, we're happy to be your trustee and make you all compliant. We will insist on and execute on a stage sell down to balance and diversify the portfolio so it meets your risk profile. So that's the risk on the small APRA fund. The only one I've ever seen dinky die, true blue, roll gold sort of SMSF with the client overseas was he merged it with his brother, and his brother had a larger balance than him. So the brother took over control. He sat back, you know, with his sort of feet up on the desk and pina colada in the hand, and off he went. So yeah, anyone who tells you just changing the directors, they don't know what they're talking about, because how is it self-managed? And I put the word self in rabbit ears and underline and bold. How is it self-managed super fund when you're not managing it? You're the beneficiary, but you're not the trustee. So it goes against the whole spirit. And those folks out there who are running SMSFs with just share portfolios in it, get out now. You don't need to have an SMSF to run share portfolios. You can run share portfolios on 10 different platforms through retail super. You can actually go and buy SpaceX and all sorts of different things. So don't think you have to run an SMSF to do that. So
that's exactly right. And I think that's, often a big miss. And I think when we look at the number of SMSFs that are currently set up and the assets being owned is just shares and cash, you're just shaking your head, because the amount of fees that they would be paying in the tax return, the tax audit on top of administration fees would be significant, that it would be eroding the actual balance and capital, because often people set them up on this idea that, go and invest in all these shares, but you can do that already. You just got to use the right retail platform on the super fund side. So good question there.
Definitely good question.
Exactly right. Next question here that I'll just load up. So this one, I feel like we've talked about it a little bit, but if one moves, primary residence exceptions, there we go. main residence exceptions to capital gains tax when coming back to Australia. We've been in Canada for 10 years, own a home here, and are planning to move back to Australia this year. We intend to sell the house here, but that probably won't finalise until after we have left and are back in Oz. Will the ATO recognise the long-term overseas primary residence or tax us horrendously for it? Good question.
Great question. And we're happy to give her the good news. So
Yeah.
as long as she doesn't own a principal place of residence in Australia, which I don't think she
Yeah.
does, she hasn't said that, and the place in Canada was their former principal place of residence, then as long as you are a tax resident in Australia, that gives you eligibility to access the main residence exemption, the property doesn't have to be in Australia. So this is one of the little nuggets we like to give our clients, but for the greater good, we're always happy to share this sort of stuff. But yeah, you can move back to Australia as long as you're renting in Australia and you don't buy a place and make that your PPR. You can certainly sell the Canada property and take advantage of the MRE.
Yeah, that's exactly right. We've had a number of clients benefit from this kind of concession. And the main reason why they've had to use it is it's taken longer to sell that foreign main residence, and they haven't had a main residence back in Australia. You can technically have an overlap with main residences. It's up to 6 months, and it's written in the ATO legislation. You can actually find it on the ATO's website, but it must be for the purpose of switching over an established main residence and selling the old one. But with that in mind, yes, can absolutely benefit from both from the main residence exemption on the reverse side, selling the former foreign main residence property.
Spot on. Nice easy one, mate.
That's the questions that we're going to answer today. We're going to save the next ones for Ben Turner when we get him online, and our managing director for the Atlas Tax Arm. I'm going to pin him down and grill him on all the changes around the budget.
Love it. Love watching an accountant squirm, because you watch them, they have so much consternation in their head when they're trying to answer a question. So, but next week will be my last week for the month of July, guys, is where I'll take off on holidays. Also the office, we're moving in office as well too. So I've got to allocate a bit of time to go through that process. And yes, it is as painful moving an office as it is painful moving a house. So send thoughts and prayers towards the Atlas Dubai team. But yeah, mate, we'll wrap it up there, leave it there. Just a bit of housekeeping, folks. Joe, our Marcoms lady, lovely lady, absolutely swings from the fences for everything expat. Keeps reminding me, man, I keep forgetting, guys, we need likes, subscribes, and ratings. So please, if you listen to this on your podcast, give us a 5-star. Bit of a comments would be fantastic, even on YouTube. Subscribe to the channel because we do this for you. We don't ask for anything for it. Mate, I'll leave it there.
Yeah, absolutely. And just a final bit of housekeeping. We do have an exit tax webinar happening next week.
Sure.
So if you're in the United States, you're a green card holder or a dual citizen, Aussie US, get on that webinar to understand what exit tax might mean for you if you ever want to give up that status with the US. We'll be unpacking a case study as well.
In the events URL, the web link below. So jump on there and guarantee if you're US linked or related, you'll get a lot out of that webinar.
Absolutely. Thanks for tuning in, guys. Thanks, Brent.
Thanks, guys. Take care.